Welcome to the Arbitration World podcast, in which we focus on significant developments and issues impacting international arbitration. We hope you enjoy this discussion. Please do get in touch with us if you have any questions about this week's episode or any areas you would like us to cover in a future podcast in this series.
Welcome to this, the second part of our two-part edition on claim finance. Before we get started, some brief comments by way of introduction. This presentation is limited in scope as appropriate for a general audience and applicable time constraints. This presentation is not offered as legal advice, which should be obtained only from properly licensed legal professionals on the basis of the specific facts of a given case. All speakers appear in their personal capacities, and any opinions or views offered are those of the speaker alone and do not necessarily reflect the opinions or views of Kernel Gates, Augusta Ventures, or any other entity or individual. I'm joined today by Andrew Roberts, Head of Construction and Energy at Augusta Ventures. As many of you will know, Augusta is a leading legal finance business which funds claimants in litigation and disputes around the world. Founded in 2013, Augusta is globally networked from three major offices in London, Sydney and Toronto, and has provided over 585 million sterling of capital to enable claimants to bring a wide range of litigation and arbitration claims, with a particular focus on commercial litigation, competition claims, construction claims, group and class actions, and bulk consumer claims. Andrew himself is a litigation and arbitration lawyer by background, having spent 10 years in private practice before joining Augusta 4 years ago. He specializes in construction disputes and heads Augusta's very busy construction and energy team. Thanks for agreeing to participate, Andrew.
Thanks for inviting me in. Very pleased to be here.
Does Augusta like to see the law firms it works with invested under ethically permissible AFAs, alternative fee agreements? And if so, how do you tend to make that work in practice in a funded claim?
The answer is absolutely yes. Funders will almost always encourage a law firm to put some of their fees on risk, perhaps defer, say, 30%, 20% with an uplift on success. The key reason for that is that it shows that the law firm itself believes in the merits of the claim, because that is obviously a key factor for any funder in considering whether to fund, is whether it's a good claim, but also whether everyone who's running it believes in it. And secondly, it can help the client in circumstances where they need to reduce or minimize the success fee that a funder will pay, because of course a funder won't be paying any success fee on an amount that it hasn't funded. So to the extent that the law firm is reducing its actual upfront cost, the funder's success fee will be reduced proportionately. And typically a law firm's success fee is slightly lower on that deferred element than a funder's success fee would be.
That's great. So you could well have, several different mouths to feed out of the ultimate proceeds of the claim. Can you just explain how a sort of a waterfall works and how it feeds into a suite of funding documents?
Certainly. So the key document, of course, is the funding agreement, and that will be very clear in setting out the waterfall, as in who gets paid what out of the proceeds and in what order. So almost always a funder will insist on being at the very top of that waterfall. The obvious logic being that the funder is the party that is taking the most risk and really needs to be compensated first, being the one that has actually put their own money on risk. It tends to be that the ATE provider, the after the event insurer, will come second, or maybe sometimes even pari passu with the funder. So their back end premium will come out of the waterfall next. But then after that, there are a number of ways that waterfalls can be structured. For example, a funder won't necessarily always need to take the whole success fee at the top. They may introduce the ability for the law firm to take its deferred fees and its uplift on those deferred fees at a higher place in the waterfall, perhaps after the funder has taken or achieved a minimum hurdle return. You might also have secured creditors that the funder has had to enter into arrangements with secured creditors of the claimant who are also depending on the outcome of the arbitration. A funder might negotiate with them that they will take a share of proceeds before the funder takes the additional amounts that it's due under a success fee mechanism. So there are a number of different factors that can be sort of sliced up in the waterfall. Generally at the back end, you will have the client taking the balance. So that's generally how the waterfall sort of shakes out. But in addition to the funding agreement, we always need to ensure that the CFA or AFA that the law firm has entered into with the client is consistent with the terms of that funding agreement and has the intent to honour that funding agreement. Also that the ATE policy is consistent in terms of the insurer's expectations of where in the waterfall it is sitting. And sometimes a funder might need to, as I mentioned earlier, enter into some kind of intercreditor deed or ranking agreement with secured creditors, and that is another instrument that falls outside the funding agreement itself but needs to be consistent with everything.
That's great. I mean, settlements are not always just cash collected. I presume you view that as the ideal scenario, but I mean, how do you look at addressing scope to open up wider settlement options and approach the valuation of non-cash receipts?
Yes, so a funder's funding agreement will generally provide that non-monetary benefits that a claimant may receive as part of any settlement or even as part of any award or judgment can be valued in the same way that a monetary award might be. And that is important as a sort of fallback for a funder. However, I would say that no funder really wants to be trying to value non-monetary outcomes and benefits at the end of a case when it is hoping to receive a success fee. And so in most cases, a funder is going to be looking for cases where it is clear that the remedy will be in damages in a monetary award, and that the likely settlement parameters are really about how much is going to be paid by the other side rather than any other kind of remedy. So one risk that can arise, and which has arisen on a recent case that we were looking at, is where you've got two parties that are in more than one dispute with one another. And we are only being asked to fund one of those disputes. So what happens to the funder if the parties decide to reach some sort of global settlement? How do we value which part of that is apportioned to the case that we were funding, for example? Or it might be that the shoe was on the other foot in the other case. So the remedy is to drop hands on both cases, resulting in no monetary benefit whatsoever and a very difficult prospect of trying to value the benefit of that overall settlement. So that is something we need to look at primarily during diligence.
And what do? Do you have essentially a dispute resolution mechanism structured within your funding agreement to deal with these issues, a valuation mechanism?
There is a valuation mechanism and a dispute resolution mechanism that covers all types of potential disagreements under the funding agreement. But as I say, it is extremely rare for it to get to that point because, generally speaking, a funder will be able to identify those risks and is unlikely to be attracted to funding a case where there is an appreciable risk of a non-monetary outcome to the dispute. But yes, it is possible and it can be done and it has been done.
That's helpful. I mean, just sort of digging further into, I guess, what we might call the suboptimal scenario where a funder is looking to exit from a non-recourse funding agreement. I mean, how does that work in practice? And I guess I should say, what are really the standard triggers in a typical funding agreement that permit the funder to exit?
Yes, well, I would start by saying that it is exceedingly rare for a funder to exit a funding arrangement. Once a funder has put significant sums at risk, it's unlikely to be in the funder's best interests to walk away from the arrangement. Much better to be involved and to do whatever we can to help to reach a successful outcome or an acceptable result. But the key grounds for termination in that worst case scenario are where a client has clearly breached an obligation within the agreement or breached a warranty within the agreement, or perhaps where there is an extreme material adverse change in the prospects of the case, and there is perhaps a disagreement as to how to manage that change. But as I say, an adverse change is normally best managed by staying as part of the team. And in almost all circumstances, the funders and the client's interests are going to be aligned. We're all trying to get to a result where there is some proceeds, and whether that be by trying to engineer a settlement or putting some further funding into bolstering the claim in certain ways, it's almost certainly going to be in the funder's interest to be a part of that. If I were to give an example of a breach that might ultimately make it difficult for the funder to continue with the funding agreement and to pursue the claim right to the end. It might be where there is a complete breakdown of trust, perhaps where the client is revealed to have willfully concealed a very key item of evidence during the diligence process, which has materially affected the merits of the case, for example. But again, it's an exceedingly rare scenario, especially given that funders' diligence process is pretty thorough, and there are many opportunities for us to ensure that we cover all bases in that regard. But if there is a termination, the ultimate result is that under most funding agreements, the funding that's already been deployed will generally be subject to a success fee as per the agreement on the amount that's actually been deployed, if the case goes on to be successfully resolved.
But you would just sort of be tagged along with any new funder, essentially. If the client were to get a different funder to come in your scenario, that's probably quite unlikely. But if they could do, and the case went on to prove successful, your sum invested would remain your essentially tag-on stake, would it, in the context of the ultimate waterfall that's constructed with the new funder?
Correct. It's certainly a suboptimal scenario, Ian, and certainly not one that we would like to be in.
Moving on now to ongoing involvement and monitoring of a claim. How far are you as a funder controlling the strategy?
So the first thing to make very clear is that the laws of champity and maintenance, or equivalent laws in most jurisdictions, mean that we cannot take control of the direction of the claim, and we will not do that. The funding agreement is also very clear about that too. So what we can do is monitor the case, monitor its progress, very much monitor the budget spend, and act as a sounding board for the legal team and the client throughout the process. In terms of controlling the strategy, or not controlling, but having a say, I suppose, in the strategy, a lot of that is done upfront during diligence. That is an important part of the diligence process. It's about understanding the claimant and legal team's strategy, making sure that we agree with that strategy in principle, making sure that that is a rational and commercial approach to the claim. And then during the funding process and into monitoring, just ensuring that the parties, as in the law firm and the claimant, stick to that. And if they don't, then we're going to have to question why. There may be good reasons why the strategy needs to shift as things go along. But I guess the key thing for us is, when are you targeting amicable settlement negotiations? Is there a mediation in your plan? If that time has passed, why did it pass, and what are we doing next to try and bring forward a resolution of the claim? Just to keep the client thinking about it as much as anything. But that's really as much as we can do. When it comes to actually potentially settling the claim, say there's a reasonable settlement offer on the table, or any kind of settlement offer, what we can expect the client to do as a matter of the terms of the funding agreement is to follow the advice of its legal team. And if its lawyers are saying this is a reasonable offer and we would advise you to take it, we're entitled to expect the client to do that. If they don't want to follow the advice of their legal team, then there is a mechanism where we can agree to put it to a third party legal expert who can also opine on the reasonableness of the settlement. But that's generally as much as we can do to not control, but to monitor and sort of keep things on track, as it were, in order to try and protect our investment.
And do you physically attend hearings? Do you send representatives to mediations or direct settlement discussions, or do you want to be kept informed of those things but essentially stay in the background? I guess it probably changes depending upon the case, but what's your general position?
General position is that we would attend mediations and we would attend hearings. Mediations in particular, we find that the presence of the funder in the mediation room is generally a positive influence. It sends the right signals to the other side in terms of the claimant's ability to press on and fight the claim if a settlement isn't available. It also gives the client an extra objective viewpoint when it comes to considering the reasonableness of a settlement offer that might have come in. So generally speaking, we like to be there and we think that we add value. Hearings, it's more a case of being able to report back internally as to how the case is going. the merits of a case can shift very quickly at a hearing, and it's much better to be there on the day, witnessing that for yourself. That's the only reason for attending a hearing, really. Occasionally, there are opportunities to settle during a hearing as well, so that's important to be on the spot for.
And in terms of what you expect from law firms in terms of reporting and the circumstances in which you go to external counsel for a view, I mean, how does that work in practice in your typical larger case?
So I think every funder is slightly different in the way they go about monitoring, but our general rule is that we will have a report that the law firm will fill out in conjunction with the client on a monthly basis. We'll normally have a monthly call or similar. And in addition to that, just being kept abreast of any material developments and keeping an eye on forthcoming milestones, seeing pleadings as they're filed, etc. That's generally the way that we operate our monitoring process.
Let's move to something a little more positive, and I'm thinking here about additional funding for additional purposes if the loan to value permits. I mean, how do you approach this, and how keen are you to look at other forms of lending on larger cases?
Very keen, actually, and it is increasingly popular with claimants that are approaching us for financing options. The general rule is that a funder is going to want to put as much money to work as possible. That is the aim of our business, is to invest money in good claims. So if we find a good claim, we'd like to put as much in as we can. The key question is, what is the correct ratio of loan to value, as we call it, that will ensure that whilst we obtain the appropriate return on our funding, the client is going to come away at the end of the claim with the result that they want and the share of the proceeds that they want. So if we've got a very highly valuable claim, say we've got a construction arbitration, I'm taking an example from earlier this year, we've got a construction arbitration that requires $10 million of legal costs funding to take it through to the end. The client would also like an upfront cash payment of $10 million at the inception of funding. And that's money that they will put to other parts of the business, for example, to put towards working capital or pay off certain debts or whatever. We're not too worried about what that use might be. The question really is, if we're putting $20 million in, are we going to be able to take a reasonable success fee on that whilst ensuring that the client takes the share of the proceeds that they deserve and that they expect? So in a situation where the claim is worth a minimum of $200 million, that's not likely to be too difficult. If the claim is only worth $50 million, we're going to be taking the whole lot on an investment of $20 million. So that is really the key question.
That's excellent, Andrew. Thank you very much for running through that, both the sort of the positives and negatives. And I think that's a very helpful and illuminating discussion. Thank you very much indeed.
That's a pleasure. Thanks for inviting me in.
Thank you for listening to this episode of Arbitration World Podcast. To listen to past episodes and receive notices for new episodes, subscribe by searching Hub Talks, that's HUB Talks, in your favorite podcast app. We hope you will join us next time for further discussions on hot topics and significant developments in international arbitration from around the globe.